Almost 1 million jobs just vanished. The latest job revision wiped out 911,000 jobs we thought existed. Everyone is blaming the tariffs, but here's the problem. That's dead wrong. This revision has nothing to do with tariffs. So if you're connecting this to trade policy, you're missing the real story. Because the real danger isn't just in the United States, it's global. Job openings are falling and layoffs are picking up worldwide. Stick with me, because once we look at the full picture, you'll see why this revision isn't just a flashing warning light for the United States. It's a signal the whole global economy could be closer to tipping into recession than anyone wants to admit. Now let's clear this up. This revision covers a period before trade policy even shifted. It covers April 2024 through March 2025. That's before tariffs even started. The real story is the labor market itself. Right now, job openings are falling while the number of job seekers is climbing. For the first time in years, we're at near parity. One job opening for every person looking. That might not sound alarming on its own, but it means the cushion the United States job market has relied on is disappearing. And this isn't just a United States problem. Canada, the United Kingdom, Germany, and China all are showing signs of rising unemployment or slow hiring. When you zoom out, the picture is clear. The global job market is softening at the same time growth is slowing. That's a dangerous combination. As of mid-2025, several major economies are experiencing rising unemployment rates. Let's go through them one by one. United Kingdom. The unemployment rate here has risen to 4.7%. As you can see, it's on an upward trend. While it's not the worst it's been in 10 years, it's clearly not in a good place. The United Kingdom recently instituted a minimum wage increase and a payroll tax hike. Both of these actions disincentivize companies from hiring. Next, we have Germany. Germany's unemployment rate has risen to 6.3%. It is approaching the worst it's been in the last decade, and it's also approaching the pandemic highs. According to DW, industry in particular is struggling with high energy costs, while exports are under pressure from US tariff policies. The German economy is suffering 2 consecutive years of recession, and GDP has shrank another 0.3% this spring. Next up, we have Canada. Canada is also approaching decades-high unemployment rates if you exclude the pandemic. In China, the unemployment rate is 5.2%. However, I don't think we can trust the Chinese data. It's better instead to look at the news coming out of China. China is no longer the perfect growth story. We have seen the cracks in China's armor with Evergrande and other financial failures. Finally, we have the United States. The unemployment rate in the United States rose to 4.3% in August. The recent revision of 911,000 jobs indicates the labor market is worse than previously reported. These trends suggest a global slowdown in hiring, with many economies facing challenges that could lead to further increases in unemployment rates. Here's why this matters. The revision cut 911,000 jobs from April 2024 through March 2025. It's the largest downward adjustment in decades. Major sectors were hit hard. Leisure and hospitality lost around 176,000 jobs. Professional services dropped 158,000 jobs, and retail fell by 126,000. Even high-paying industries weren't immune, showing the breadth of the slowdown. This will reshape how policymakers and markets see the economy. The Federal Reserve sets rates that banks borrow at, which then affects the rates you and I pay. With a weaker job market, they're more likely to lower rates to support the economy. While there was political debate around labor data, Politicians are more likely to try to support the economy if they feel people are losing their jobs. This can support the stock market in the short term, but there's only so much one can do once the snowball of recession starts. The only bright spot is that corporate revenues are still strong. Many investors will view the rate cuts, government support, and strong business financials as a bullish sign to get in. Instead, I think we should be viewing this as a last chance to get out. Globally, major countries' economies are struggling as well. When multiple major economies start to see rising unemployment, it's not just a local problem. It's a signal that the overall global economy could be in retreat. Financial markets often react well before official recessions are declared. Warren Buffett has been on the sidelines for a while already. At this point, there may not be much upside left to get from the stock market. With these trends in mind, broad sector job losses, rising layoffs, and global softening, it's clear that broad market risk is rising. The cushion that has protected the labor market for years is disappearing, and that can put pressure on stocks. That's why I'm adjusting my own positioning. I'm increasing my short exposure to the general market. I will offset this by focusing on areas that can thrive even as the labor market softens. Artificial intelligence is my primary focus. I expect it to be the most resilient sector during a downturn as labor is increasingly replaced with automation. This means I'm looking at artificial intelligence chip companies like NVIDIA and data center leaders like Amazon, Microsoft, Google, and Meta. I'm also looking into the energy sector. While some utilities may face regulatory constraints, artificial intelligence and data-driven demand create a stable floor for energy consumption. Certain energy plays could be a safe harbor in an otherwise turbulent market. I'm still finalizing my top picks here, and I will share them once the ideas are fully baked. I'm also investing in gold, as I believe governments and central banks will flood the economy with money during any potential downturn. This approach allows me to still stay long and benefit from any potential upside, while having downside protection should the stock market crash. The goal isn't panic, it's positioning with foresight, taking the data seriously, and navigating the stock market with a strategy that acknowledges both risk and opportunity. The almost million job loss revision shows a labor market that's softer than previously reported. The ripple effects are being felt globally. Broad market risk is rising, but don't panic. Corporate revenues remain strong, and there is still time to maneuver. Opportunities exist in artificial intelligence, select utility plays, and gold. We will continue to explore these on the channel. Leave a recommendation on what you think I should cover next. Please like if you got any value out of this. Do you see the labor market softening as I do, or do you think it's just a temporary blip? Let's discuss. Bye.